Hello, good evening, everyone. Welcome back to this another series of our webinar for our customers regarding investments opportunities. Today, we are seeing that yes, markets are all-time high. Nifty is about to reach 20K. That is a historic number, and we all are waiting for such kind of opportunities. And I have seen people who continuously ask me that what is the right time to invest. I believe there is never a right time to invest, but it is always the time you decide you should invest. I think that is the right time for you. Considering markets at all-time high and people have such kind of queries and thoughts in their mind, we thought that we should ask a speaker who is renowned, who is expert in this industry, who can share his valuable thoughts that how the equity market is performing, what the outlook seems, and what should be the right investment opportunity in this scenario. And that's how we reached out to Invesco Mutual Fund, EMC, who is a renowned AMC for the last couple of decades. They are helping customers to grow their wealth, and we couldn't find any other person better than Mr. Tariq Badshah. Taher Badshah is the CIO of Invesco Mutual Fund, and he has over 29 years of experience in Indian equity markets. In his role as CIO, Taher is responsible for the equity and fixed income investment function at the firm. He has been in Invesco for the last 6 years, and before that, his previous role was with Motilal Oswal Asset Management as head of equities. He was responsible for leading the equity investment team. In the past, he also worked with Kotak Mahindra, ICICI Prudential, Alliance Capital Asset Management, and Tahir holds a master's in management studies with specialization in finance from SP Jain Institute of Management and BE degree in electronics from the University of Mumbai. I don't want to take much time of Tahir, and I would like to hand it over to Tahir to share his valuable thoughts in the equity markets and how the outlook is and what the investor should do in this current scenario, whether he is looking for lump sum investments or a systematic investment, what should be the right approach of the investors in this. So, hand it over to you, Tahir. Thank you so much.
Uh, Thank you, Mohitji, and good afternoon, everybody, all the viewers. Mohitji, thank you very much for having me on your platform on this very renowned and very prominent platform of Bajaj. Uh, Happy to be here and share my thoughts and views. Uh, what I'll probably do is that I'll try and encapsulate what probably uh, is our thought process with regard to the markets and the economy at a very high level. Probably
Yeah.
I will, in doing so, probably I will have to step back a little bit and go back to maybe let's say the start of this calendar year or a little before the start of this calendar year and try
Mm.
to then piece things together and
Sure.
see what probably has changed and
Yeah.
what do we see as the path going forward. Uh,
Okay.
of course, there is this excitement in the market about markets having actually now finally scaled up and broken out into a new high in the last month. I think if we as investors or we as fund managers and in the investment community, at one level, do not get too excited by new highs uh, because new highs, while of course they set a new milestone and it is always very uh, exciting to be in a new zone. But we have to see it more in the context of where we are with regard to the economy and more importantly with regard respect to valuations. And I think more than the new highs, which is obviously very exciting, the good part is that these new highs this time around in the market are coming at a somewhat different configuration. Generally, new highs are associated with very hefty valuations, very peak, very expensive kind of markets. And typically, in the past, we've also seen the new highs always come at the time when interest rates are at the bottom, or probably interest rates are falling. Uh,
Yeah.
what makes it special for the markets to be in a new zone this time around is that it is coming at a time when actually valuations are not at their peaks. Uh, Today, Indian markets are probably trading at, let's say, somewhere around a 20-21 times 1 year forward multiple. Uh, in the past, when new highs have been achieved, multiples have gone to as high as 25 times and 24 times 1 year forward as well.
Mm.
So to that extent, actually, this new high is not accompanied with a you know a burst out of valuations. Valuations are still relatively reasonable. The other thing which is important or which is different this time around as yet is that, as we all know, a new high in the market is occurring at a time when interest rates are actually at their peak. Uh, whereas, as I said, most occasions in the past, we've seen markets get into a new zone or new enthusiasm, a new ranges getting established when interest rates are at a low. So we have the whole. What it implies is that basically we have the whole of the uh, interest rate down cycle, which can probably come about in the next couple of years to
Yeah.
benefit out of. That will benefit not only the economy if interest rates start going down, but as we also know, valuations of the equity markets are inversely linked to interest rates. So as interest rates go up, valuations come down, which is what happened in the last 1 year. And as we now see the possibility of inflation coming in control and interest rates probably going down, it opens up the upside for the markets from a valuation standpoint as well. So that
Okay.
makes this new high somewhat different and at the same time more exciting. Uh, why I say this is because, over the last some weeks, couple of weeks, as the market has moved into a new high, I've always received refrain from investors, clients, etc., to say that, look, I mean, if the markets are in a new high, is it a time to book profits, and therefore, take money off the table? And
Yeah.
well, I think this time around is different to that extent. I mean, this market is not getting into a new high without legs. It has
Yeah.
got further legs in the form of some of these economic indicators which are still in our favor, whether it be in the form of inflation easing, interest rates easing, and like as I said, even valuations not being as demanding as what we have seen in new peaks achieved in the past. So I think that being said, now let me just take back and try and you know uh, give you an understanding as to why we believe that the complexion of the market will change and the market probably will become a lot more broad based than what it has been, and we probably look like being in the in a at a time when a new economic stroke market cycle would have commenced, and which can probably continue over the next 3 4 years as well. When
Yeah.
we were uh, sitting towards the end of sitting in end of 2022, let's say post Diwali last year, uh, we at our end were somewhat, you know cautious and somewhat anxious about the equity markets in India. There were two reasons for that. One was that throughout 2022, the last calendar year, the Indian markets, despite many of the headwinds which came in the global economy, such as the Russia Ukraine war, rise in commodity prices, rise in oil prices, and the fact that interest rates had started to go up, our markets, however, were very resilient, at least compared to many of the global markets. Uh, by the end of 2022 or towards the end of 22, India had almost the markets were almost flattish. We had escaped without any damage uh, compared to many other countries in the world, developed as well as the emerging markets, which had seen declines of anywhere between 10 to 15%. So versus that, we obviously did very well. What this ended up doing, however, is that uh, the Indian markets versus the rest of the world started to look a lot more expensive.
Okay.
Some of the concerns which were there around the world were there for India as well, such as inflation being a lot more stickier and interest rates being going up. The same feature was there in India as well. India, however, was obviously benefiting from the fact that our growth rates were a lot more resilient, a lot more better compared to many other parts of the world. But having said that, our valuations had also become pretty expensive, especially versus the rest of the world.
Yeah.
The other thing that we were starting to see as a problem, second problem that we were witnessing at that time, was that when you look at the Indian economy and divide it into two parts, there is there is a there is a component which is the consumption part of the economy, which typically accounts for about 61, 62% of the Indian GDP, and then there is a balance 38 odd percent, 39 odd percent, which is what is the investment uh, portion of the economy, the investment part of GDP. Now, in the last 1 year, in the last 1.5 years, or towards, and as we were approaching 22, what was happening was that there was a very strong growth and visibility of the investment part of the economy. The investment section of the economy, which is basically about infrastructure,
Yeah.
manufacturing, industrials, you know, urban
Hmm.
transport, roads, railways, defense, all that was doing pretty well. And, we were seeing a lot of strength post COVID. On the other hand, the consumption part of the economy which is the bigger part, the 61% part, was actually starting to see some signs of strain. There was a certain slowdown that we were already witnessing, especially post Diwali, and particularly after the pent up surge that we had once we had come out of the COVID lockdowns.
Yeah.
So that was something which was kind of concerning, because the consumption part is a relatively larger part, uh,
Hmm.
and it was starting to kind of slow down. Uh,
Okay.
Maybe the impact of interest rates was actually starting to tell on the consumption part of the story. So we therefore were moving with a somewhat more cautious view. We felt that Indian markets may find it difficult very easily to scale new highs until one or both these problems actually is resolved one way or the
Yeah.
other. And so we took a somewhat defensive stance, and we were expecting that 2023 would be much of it would be spent in
Hmm.
readjustment to the post-COVID effects of interest rates, inflation, and growth also normalizing.
Hmm.
It's been now 8 to 9 months since we had that view in mind, and up until very recently, we had seen that the markets were almost range bound and
Yeah.
uh, generally going through some bit of soft patch, and a combination of some small absolute correction and time correction as well. As we stand today, there are a few things which have changed since the last 8 9 months that we took our view. What has changed? The one thing which is few things which have changed. The first one is that um, the relative valuations of India, which, as I said, were looking a lot more elevated at the start of last of this year or the end of last year, are now a lot more reasonable. This has
Okay.
happened because the Indian markets have been stagnant or stable until very recently, whereas the world markets have actually gone up. Many of the other
Yeah.
markets have done much better than probably the Nifty has done on a calendar year to date basis of the last 3 quarters. So the valuation challenge that we were faced with was almost have almost was looking like having been overcome, and it was offering a better value than what it was offering few quarters ago. The second thing that happened to our uh, you know positive surprise, to our surprise, was that uh, the growth did not slow down as much as we had feared. So
Yeah.
even though the growth characteristics in the economy still are a little mixed, but markets had an expectation that the slowdown will be uh, lot more acute, which has not come to pass. So it's more about the outcome being a lot less negative than what we had anticipated it to be.
Yeah.
Then there is a couple of other things which happened. One other thing that we were running with also was the fact that even though we had seen very high interest rates in 2022, uh, we were of the opinion that there might be some small residual rate hikes which may still happen in early 23, and after which most likely the central banks around the world, including India, would go into a pause mode in the by the second half of 23. As it
Okay.
has turned out to be, we know that the pause has been called earlier than we thought so. So RBI called out a pause in, I think, May, and then of course more recently even it was reaffirmed by the RBI with a second pause, and alongside which even the US Fed and Fed also actually started uh, to go into a pause mode. So this came as a positive surprise to the market that it has turned out to be earlier than we thought. Now this doesn't necessarily imply that we get into a rate cut mode very quickly,
Yeah.
but
Yeah.
it just at least relieves the economy from any further hikes to come through in the near future. In fact, our view as of now is that given the way uh, the real interest rates have moved, so real interest rates in the economy have moved from reasonably negative to now positive.
Okay.
Last year, interest rates were rising, and last year, in fact, interest rates were low and were rising, and inflation was at all-time high. So actually, it was we were in a negative real interest rate scenario. Uh, in 2023, we've seen inflation come down, even as interest rates have actually gone up. What this has
Okay.
done is that has made real interest rates actually positive. So now
Yeah.
our interest rates are actually higher than inflation. Now,
Hmm.
this basically becomes a good starting point for central banks to step back, not raise rates anymore, because if you keep raising real interest rates, then beyond the point, it can start hurting the economy and the economic
Right.
growth.
Yeah.
So we feel that this pause essentially acts as a buffer and supports the possibility of no further rate hikes from here,
Hmm.
and just about opens a small window of rate cuts coming through, if not in 23, then sometime in mid to later part of 2024, depending upon how the
So,
economic
Tahir, in
scenario
that case,
moves.
sorry, I have a question here
Yes, please.
related to this.
Yep.
What you said. In such kind of scenario, people who are investing already in debt schemes, or maybe who are planning to, because since it's a all-time high interest rate scenario as well, when bond yields are high, what do you suggest for the people who are having conservative approach? Should they go ahead with investments in debt at this point of time?
Well, I think we still have that window of opportunity as far as debt is concerned. We have been incrementally.
Tahir,
Since the
there's some
start.
network lag.
Yeah.
Yeah,
Hello. Can you
yeah,
hear me?
please.
Is this better?
Yes, now it's on. Yeah,
Okay. So, since the start of this calendar year, when we were finding equities to be a little controlled, or we were holding back, uh, we still were finding good opportunities as far as fixed income was concerned, and that was simply because yields at that point in time were tracking 7.6 and above.
yeah.
Even our 10-year was at nearly 7.5, and
Hmm.
these were very good yields to lock in. We were also, as I said, of the view that bulk of the interest rate hikes were behind us, and if at all, we would have had small doses of residual interest rate hikes in 2023.
Right. Yeah.
And therefore, if somebody is taking a 12 to 18-month view, there is a very good chance that not only do you lock yourself into strong YTMs, you
Hmm.
also open up the possibility of rate cuts going forward, which can
Hmm.
actually bring you that extra capital appreciation over the next 12 to
Yeah.
15 months time. So I think that window is now gradually quickly closing. So we have seen some rates come off, in the sense that 10-year has come off a
Yeah.
little bit, but it is still very attractive. I mean, at 7% plus on the 10-year, and YTMs, and at least the low to medium duration products, still anywhere in the vicinity of between 7.4 and 7.6, is still very good yields to lock into. And I think with the pause of the
Yeah.
RBI, two consecutive pauses, the
Yeah.
possibility of rate cuts becomes even more stronger in 2024.
True.
So I
True.
think this window, before it closes down further and you see some correction in yields, I think it would be very important for investors to take advantage of this, and lock themselves into a few categories of fixed income products, particularly on the low end of the curve, and
Okay.
now we are even probably inclined to go somewhere up on the ladder, even up to the 3 to 5 year duration. I think we are reasonably positive on the curve.
Okay. So maybe medium to long term. duration funds category
Short to medium
can be
term is
something
what I would say.
short to
Short to
medium
medium
term.
term is the duration. We are obviously the 1 to 3 year bucket is still looking very attractive, and we are adding
Right.
to some duration in certain other products. So as we get into the 3 to 5 year bucket, that also looks equally attractive, as the
Okay.
promise of uh, low inflation and possibility of rate cuts becomes
Right.
stronger as we go along.
Okay. Okay.
So, Mohit, right now we have actually got a situation where, and this doesn't happen very frequently. I mean, it happens on a few occasions that
Sure.
both the sides of the coin, the equity as well as the fixed income, actually look very attractive. Uh, Equity has its own reasons that, like as I said, uh, we are we are looking at a broadening of the economy, and I will explain a little more of that. Uh, just like the
Yeah.
market, we are also expecting the economy to broaden. And the second thing, as I said, we are at the high end of the interest rate curve. Mostly, we will only go down from here, and there's a
Yeah.
higher probability of it going down than going up, is how I would put it. And the third, of course, being that we are looking forward to a much better economic cycle in India over the next 3 to 5 years compared to what we've had in the last 3 to 5 years. So it makes the case for equities a lot more stronger. The other feature that so why is this likely to happen? I mean, uh, like as I said, there are two halves of the economy: the investment part and the consumption part. The
Yeah.
investment cycle in India had, in any case, got pretty strong since the last 18 months, thanks to a combination of uh, uh, corporate balance sheets improving, bank balance sheets having got stronger, and thereby their ability to lend in the market having increased, government
Yeah.
policy being very supportive, some of the global conditions like China plus one also contributing. And last but
Yes.
not the least, as the government came out of the COVID fiscal stress, the government's capital expenditure uh, has increased significantly as a percentage of GDP, and has led to a scenario of a very strong entrenched public investment cycle, alongside which now in the last couple of quarters we are also starting to see private sector capex come through. So that part of the economy is very solid, and we can see it all around us. uh, our sense is that conditions are developing now for the consumption part of the economy, which was lagging up until now, as I said, or was somewhat, you know, subdued or moderate, may also join the party in 2024. Why will this happen is because of two things. One is that commodity prices are actually a lot more benign compared to last year, which was not the case in 22, and which led to inflation being high, and to some extent affordability had got affected. With commodity prices now being a lot more reasonable, the the uh, inflation in product prices is probably not going to be as much, and that means that the affordability, especially in certain sections of the economy, such as the low to mid end of the income pyramid, tier 2, tier 3 rural parts of the market which have not done well, can likely come back. The second thing associated with it, as we discussed, is the possibility of interest rates coming down as well. If that were to happen, then that provides another leg through which you might see consumption, strengthen. And last but not the least, another reason why consumption was probably on the back foot uh, was on account of uncertainty with regard to the monsoons. Uh, to India's good fortune, while we started on a rough note in the month of June, July is turning out to be a bountiful month as far as rains are concerned. Probably in some cases, maybe more than what we need. But nonetheless, I think it's a very solid recovery of the monsoon pattern. Uh, Last word is still to be said, and maybe it might not be before the end of the month of September when we get a full picture. But I think
Yeah.
sentimentally and even from a um, ground level perspective, this comes in as a very good incremental positive. So we believe that. in 24 we may have a year and beyond 24 and starting 24 beyond, we may have both the engines of the economy start to fire. So we're already in a good investment cycle.
Okay.
Investment cycles, when they start, they don't end in a hurry. We may be in about, we may have already covered about 12 to 18 months of that cycle, but these cycles go on for
Yeah.
at times even 4 to 5 years. So it has got some
Sure.
decent runway for it to continue. And alongside which, if we get the supplement of
In fact,
consumption as well,
I would say
then we
gold.
get into a
Yeah. In fact, I would say gold as a category is also chasing equity and debt, and gold also says that I don't want to
go
lag
down.
behind. And since considering it is also at all-time high prices, so I believe right now asset allocation is the need of an hour. That person should allocate his funds in a portfolio in such a manner that all asset classes should be part of it, and that is where I believe our viewers need to focus on merely primarily in such kind of scenarios, that how they should allocate funds in their portfolio.
Yeah, look, I mean, you're right, actually, Mohit. In fact, I would add one more asset class which is doing well after a very long period of time, which is the housing and the real estate cycle.
Yes.
I mean, from an Indian investment basket standpoint, which is by
Hmm.
and large a combination of equity, fixed income, gold, and real estate, uh, all
Yeah.
of them are in a sweet spot as we speak. In fact,
So
the
I think this is a golden period where all the sectors, all the asset classes
are
are
doing well.
complementing each other, I
Absolutely.
would say. So
Absolutely.
right asset mix can do strangely wonders in the portfolio.
Yes, so I think in net I would say that the path. So in a very in a nutshell, I would say that look, what's happening is that the headwinds which were there in the early part of the year uh, are gradually receding. Markets love it
Yeah.
when you have a scenario where there are not many headwinds to contend with, or
Hmm.
not many uncertainties to
Yeah.
contend with. Today, many of the uncertainties, whether it is commodity prices, whether it is interest rates, whether it is growth, are gradually
Hmm.
receding, whether it is monsoon, are gradually receding. The only
Right.
one or two uncertainties that you might still want to probably grapple with is, and which probably nobody would have answers to, are
Hmm.
maybe tail risks of geopolitical effects and the
Yeah.
tail risk of possible political disruptions, if at all, as we get into
Right.
the run up to the 2024
Yes.
elections. But
Yeah.
probabilistically, uh, on both these scenarios, particularly the latter, which is about politics, India politics,
Hmm.
it's very hard to contemplate or conceive of a meaningfully different configuration as things stand now.
Yeah.
So, if that being the
True.
case, then the markets then have a very clear runway. They've got not
Hmm.
much to worry about in the, let's say, the next 9 to 12 odd months, from now until maybe somewhere closer to the May 24 period.
Yeah.
And so I think markets may continue on the strength. I also
Hmm.
expect the markets, you would have also noticed that there's one more behavior of the market which has been somewhat different this time. The last 6 months, 3 months, we've seen meaningful rally in the mid and small cap parts of the market.
Yes. I
And
was about to ask you your view on the same, considering it's favorite of the people right now, and people are so much concerned about that. What should they do with their mid and small cap portfolio allocation? Good, you have brought this.
yeah, sure.
Would love
So
to hear that in detail.
yeah, so it's a little inverted this time around, in the sense that typically markets break into new highs is led by the larger cap, the established companies. This time it has been the other way around, and then after that, mid caps and small caps follow. But this time it is the other way around.
Sure.
The rally has first occurred in the mid and small caps. It at some level demonstrates the resilience of the domestic economy, because mid and small caps are generally more levered to the domestic market or the domestic economy. Large cap companies have not only domestic drivers, but they also have international drivers of growth, because they have an export footprint,
Hmm.
many of them. So, or they have international businesses. So, uh, I expect that as the economy broadens, uh, the large caps will also join the party. Uh,
Right.
Besides the fact that what will also help the cause is the and there's another point which I probably missed out in discussing in the early part of my conversation, that uh, foreign investors are now looking at India a lot more favorably than they were looking at the start of this year.
Yeah.
We have seen a surge in foreign inflows in the last 2 quarters, in any case, and we expect that this could probably strengthen on two counts. One, the fact that at the initial part of the year, China was considered as a more attractive destination because they were coming out of COVID and they were likely to show decent economic strength, and uh, which has changed in the sense that China's story has not turned out to be as great as what investors started to think about in the beginning of the year. It is still early days, but there is a certain amount of disappointment as well, and therefore, uh, foreign investors are now wanting to diversify and also consider go back to India because of its resilience and growth, valuations having come off, uh,
Yeah.
and uh, making India too equally attractive or even more. And the second thing which has happened, which has turned the attention of foreign investors to India, which generally happens, is the decline in oil prices. Oil trading below 80 uh, is another positive feature for India.
Yeah.
So I think uh, I expect that the markets will broaden, and if foreign investors continue to uh, you know pour money, it will.
Yeah.
It's quite likely that the large caps also start participating in the rally. So we will not only see the continuity of the mid and small caps, because mid and small caps, see, look, we are seeing very strong performance in the last 6 months or 3 months, but we should not forget that on a CAGR basis of the last 3 years, the mid
Yeah.
cap and small cap performance is not something very exciting. It's not
True.
that
True.
they have returned 25% CAGR. The CAGR returns of large cap, mid cap, and small cap are not very different on a 3-year CAGR basis. In fact, mid and small caps are lower than Nifty. So uh, this rally on mid and small caps can extend itself, and alongside which I expect the large caps also to participate or to join and contribute as well. Investors therefore may want to now even consider, if not the the very pure large cap funds, at least start considering some of the flexi cap type
Yeah.
of products, which
Yeah.
gives you good exposure to large caps and also
As well
provides
as
you that
mid and small.
flavor of mid and small caps.
True, true, true. About since you have already mentioned that valuations in India are quite reasonable at this point of time, and the growth is also there. Do you think at this point of time investors should look at global funds or equities as far as
So good that
investment?
you good that you bring this up as well. And yes, I would say that there are a couple of uh, places or couple of sections of the global market which are also looking attractive.
Yeah,
Uh, in 3 or 4 years ago, I think there was a lot of initial enthusiasm and hype, if I were to use the word, around foreign securities, buying foreign funds, and so on. Probably for many of the investors, it didn't turn out to be a very pleasant experience overall, uh, especially in the last 1 year, because many of these global funds saw a very massive correction because of the adverse interest rate cycle, especially in developed markets where interest rates went up by anywhere between 400 to 500 basis points.
yeah,
Uh, I see some of these more like contra opportunities. Uh, you know, uh, to me, they look like being uh, opportunities of buying some decent quality funds or businesses uh, of operating in the global context and available at now a lot better valuations than they were earlier, or they were, let's
yeah,
say, 6 quarters ago. So I
Okay.
see them as contra opportunity. Like for example, we at our end and Invesco, we have a global consumer trends fund of
Yeah.
fund. Uh, that fund was launched sometime in early 21, and unfortunately, uh, we timed it quite horribly because uh, it was a growth oriented strategy, which we
True.
obviously were looking at from a more long term perspective. But the timing was absolutely atrocious because we we collided with the peak of the interest rate cycle at that point in time.
Yeah.
I mean, rather the bottom of the interest rate cycle at that point in time, and saw massive erosion in the NAV by almost 40-50%.
Right.
Uh, but does that make them completely uninvestable? I don't really think so. Does it mean that those are now uninvestable altogether? I think, in fact, they are looking a lot more attractive now than they were earlier. Uh,
Okay.
if one has a view that if not now, but over the next 12 to 18 months, the not only the India but the global investment interest rate cycle also may turn down, then many of these growth oriented funds, uh, what happened to let's say the Nasdaq and what happened to let's
Yeah.
say this
Yeah.
these growth oriented international funds, all those may start reversing trend. Some reversal
Okay.
is already visible of late, and I think that can. And you know the interesting thing is that once again many of these funds are now you're buying uh, funds which are complementary to the India story, uh, and you are getting a chance to buy some global businesses at very attractive valuations. So I see them more as my global contra opportunities at this stage of the market. Maybe you could use them as tactical plays, if
Yeah.
not for structural reasons. But I think there are some of them who offer both the potential of a tactical rebound and, if you're convinced enough, even as a strong structural play for the long term.
Got it. So I believe again that asset allocation part comes into the picture. That yes, there are so many asset classes and there are so many sectors to invest in, but people have to carefully review their own portfolio, considering the opportunities and their exposure in the same. Good.
Absolutely.
So we have got a question from Miss Shikha from Mumbai, and she's asking that I have invested some money in a Nifty index fund of one of the AMC, and the fund is giving decent returns. I am holding 10 lakh rupees for the last 6 months, considering markets will go down. But now it's at all time high. How should I invest this 10 lakh rupees in the market?
No, I think Shikaji, what I would say is that if you are, I don't know what your portfolio configuration looks like, but Mohit of course started off by saying that
So she
there's
has
never a good
specifically
time.
mentioned 90% of existing portfolio is in the single index fund only.
Okay, so then
So
I think
I
clearly
don't think there's any
there
allocation.
is. Okay, all right. So that clearly is suggestive of the fact that you need to broaden. As I said, that more asset classes will probably come to play. Uh, I think what you have is obviously also holds a lot of promise, but I think you could add to a couple of more funds, probably in the flexi cap space if you don't want to directly immediately move into the mid or small cap range, if depending upon your risk profile. So if you have a somewhat moderate risk profile, then I would say that you should move from at least the large cap to the flexi cap category. That is what you could consider at this stage. Meanwhile, also look at a small allocation, probably in the vicinity of 10 to 15% of your overall investments in a couple of global strategies or global funds as well. But
Right.
clearly, you have it's I think you can do with some more diversification than where you are. And this is, I think, I would have said this irrespective of where we were in the market and where we were
Yeah.
in the economic and investment cycle. Uh, but given that the opportunity is now looking a lot more brighter, I would only say that you should do it
Yeah.
a lot more expeditiously than otherwise.
Got it. Got it. And when you say to expose in a different kind of funds, do you suggest a one-time lump sum investment in this scenario, or STP should be the route to be taken care of?
Well, I think I would say that if you are and now at this stage of the market, I would say if you're getting into mid and small cap as a category, I would now prefer doing a SIP. With
Okay,
maybe you can start with some initial uh, good, you know, lump sum investment, uh,
right,
but then follow it up through an SIP mode uh, for the rest of it. And if you're doing flexi cap strategies, then I would rather prefer a lump sum mode because that category is still not as warmed up, or it is still a lot more attractive from an entry point perspective. So if you want to take advantage of that opportunity, I would rather that you devote a larger proportion at the entry itself or as a lump sum.
got
So
it.
I would do exactly the reverse in the sense that I would spread my mid and small cap allocations over time at this stage, and I would be a lot more front footed as far as my flexi cap or large cap allocations are concerned. But given that you already have a very good exposure to large caps
Yeah,
in the form of your Nifty fund
yes.
ETF, the next step for you to do is move to certain flexi cap categories or flexi cap strategies.
Great, great. Thank you so much, Tahir. I believe during our discussions, I can see another three questions which are related to gold, related to debt and international markets. I believe our viewers have got the reply and the responses from the industry expert, and that helped him. That helped, of course, help them to understand their own portfolio and the investment strategy they should have, considering the view of next 3 to 5 years in equity and at least 1 to 2 years of view in the debt, how the movement will be. But yeah, we would say, and I always say that as you do the health review for you on annual basis, you should always have a financial review as well, so that you can understand what exactly need to be taken care in the portfolio, and accordingly you can make some wise decision about your own investments.
Absolutely, I couldn't
Any
agree more.
closing remarks, Tahir, for our viewers um,
I would
in
I
this
would only
particular?
close by saying that look, I mean, we've been waiting pretty long for this new India cycle to emerge. I think as a country and as a nation, we've got almost all the elements that we would like. We can never have everything going for ourselves, but we have bulk of it going for ourselves at this stage, and therefore we are at the cusp of a new cycle in as an economy as well as the market. I think investors need to be cognizant of that, and as you pointed out that we immediately need to review portfolios allocations. Uh, we are coming very
Yeah.
close to the end of the phase where we should stop thinking and start acting. So I think that is what I would leave the audiences with, that it is time to put money into action and wait for those returns to come through over the next few years.
True, true. Patience is the key, and there is never a right time for investment. I think investors should view the same and start your investment today, irrespective of the fact that yes, markets are all time high, but you never know where it is heading in next couple of years. So thank you
Sure.
so much, Tahir. Thank you, our
Thank
viewers,
you
and
very
thank
much,
you,
Mohit,
Invesco
once again.
team, taking out your valuable time. We'll definitely keep engaging with all of you, and definitely we'll come up with the next round of wonderful speaker series, and on another new topic which is much relevant for your own investment portfolio. And keep watching the space. You can explore Bajaj Finance app for key updates and the platform for mutual funds where you can explore and you can get more information about the funds, NFOs. And Tahir, definitely seeking your time maybe in another couple of months so as to have another round of topics so that you can share your valuable thoughts with us.
Most
Thank you so
certainly,
much
we'll
for
be
your
happy to
time.
once again participate. And thank you very much for having me on the show. And good
Thank
luck
you.
to all the investors and viewers. And
Thank you
good
so
day.
much.
Thank you very
Thank
much.
you, all the viewers. Have a good day. Thanks.